All right, welcome back. Today, we're diving into a company that, is literally part of the foundation of North America's infrastructure. We're talking about Stella Jones. They're a huge player in pressure-treated wood products. So think of things like railway ties and those big utility poles you see everywhere. Okay, let's get into it. But here's the big question we're really asking today. Can a company that makes, well, wood poles and railway ties actually triple your money? It sounds kind of boring, right? But that's the goal we're putting to the test, hitting a 9% average annual return over a 16-year period. So, is it possible? Let's dig in and find out.
To really understand this company, I love this analogy. Stella Jones, it isn't the flashy sports car of the stock market, not at all. Think of it more like the engine in a massive freight train. It's not glamorous, but it's incredibly powerful, it's absolutely essential, and it's built for the long, long haul.
So, we're going to approach this like a real investigation. First up, we're uncovering the company's core strengths. What exactly makes this engine so darn powerful? And the first big question we have to ask is this. Does Stella Jones have what investors call a moat? A durable, competitive advantage that keeps the competition at bay. And the answer is, yeah, it does. A moderate one anyway. But what's interesting is that its moat isn't built on some fancy brand name. Nope, it's all about its operational backbone. First off, you've got sheer scale. They have so many treatment facilities all across North America, which gives them a huge advantage in distribution and costs. Second, their customers, we're talking giant railroads and utility companies, are basically locked in. They value reliability above everything, and switching suppliers is just a massive headache and risk for them. And finally, you have regulatory barriers. Getting the environmental permits to build one of these treatment facilities is a nightmare, which really deters anyone new from even trying to get into the game. Okay, so a solid operational moat, that's great. But what about the people actually running the show? Is the management team any good? And maybe more importantly, are they looking out for us, the shareholders? Now, check this out. This one number on the screen, it tells such a powerful story. In just the last 5 years, the company has bought back and retired almost 15% of its own shares. So what does that mean for you? It means management is taking company profits and using them to reduce the total number of shares out there. This makes your remaining shares a slightly bigger piece of the whole company pie. That is a textbook sign of a shareholder-friendly team. All right, so we've got a solid business and good management. That's a great start. But now we get to what might be the most important part of this whole thing, the valuation. What is this company actually worth compared to what its stock is selling for on the market right now? So after running all the numbers, blending a couple of different valuation methods, one that looks at future cash flows and another that focuses on current earnings, the analysis points to an intrinsic value right around $117 per share. Just think of that number as our best guess for the company's true underlying worth. Okay, so that's our value. Now let's look at the market. What's the price on the ticker? As of the date of this analysis, it was trading for $95.36. So here's the key part. The difference between that intrinsic value, the $117, and the market price of around $95, that gap gives us a discount. Investors call this the margin of safety. In this case, it's about 19%. This is your buffer. It's what protects you if your analysis is a little off or if things just don't go perfectly. Now, a 19% margin of safety is pretty good. But hey, no investment is a sure thing. So let's switch gears and look at the risks and the different ways the future could unfold for this company. If we do a quick SWOT analysis, strengths, weaknesses, opportunities, and threats, the final score comes out positive. The biggest strengths? Well, that's the constant demand from infrastructure projects and the fact that they generate a ton of free cash flow. But, and this is a big but, look at the biggest weakness, which is weighted just as heavily. Leverage. That's the company's debt. That is definitely the key risk we have to keep an eye on. And this chart really paints a picture of the range of possibilities. Our main estimate, our base case, is that 117 intrinsic value. But look, in a bear scenario where things go wrong, the value could drop closer to $90. On the flip side, in a bull scenario where they knock it out of the park, it could be worth as much as $145. Understanding this whole range is absolutely crucial. Okay, we've looked at the business, the management, the valuation, and the risks. It's time to put all the pieces together and get to the final verdict. And this takes us right back to our original goal. Let's forget about trying to predict what the stock market is going to do tomorrow. The real question for a long-term investor is this. If our goal is to make at least 9% a year on our money, What's the absolute most we should pay for this stock today?
And this is where the rubber really meets the road. This table is so practical. It shows that the price you can afford to pay really depends on how long you plan to be an owner. If you only want to hold for 5 years and get that 9% return, you'd need to buy in at $76. But if you have a 16-year horizon, just like our original goal, you can pay up to $90 a share and still expect to hit that target.
So, with the stock currently trading around $95, the verdict from this analysis is crystal clear. Right now, it's a hold. To hit that 9% target, you'd want to be accumulating shares below $90. And if we get some kind of cyclical downturn or recession and the price drops even further, say below $85, well, that's your signal to buy aggressively. Look, if there's just one thing you take away from all this, let it be this. Stella Jones is a super solid, durable, critical infrastructure business. But, and this is so important, just because a business is fantastic doesn't automatically mean its stock is a great buy at any price. To get those really strong, long-term returns, you absolutely need patience and price discipline. And that's our deep dive on Stella Jones. It's a really fascinating look at one of the engines of our economy, isn't it? So now I want to hear from you. What companies should we put under the microscope next? Drop your suggestions in the comments below. Thanks for tuning in.